05's attention. Picture one bank's doors slamming shut. Suddenly, the heartbeat of a whole city flatlines. 510's authority. Greg Hale here, financial history sleuth with 20 years of sifting through dusty ledgers and court filings. 1015 agenda. Today we crack open the domino chain that started with a quiet trust company and almost took down every bodega, railroad tie, and household ledger in Gotham. 1530's disclaimer. Just so you know, everything you're about to hear is stitched from real paperwork. Names got tweaked where folks asked for privacy. 3045's first source. When the Knickerbocker Trust folded overnight, panic rippled through every uninsured shadow bank, laying bare how fragile the whole system had grown. Source. October 1907, and a chill wind cut through Manhattan. Rumors flew faster than the ticker tape. The Knickerbocker had bet too big. By noon, depositors were shoulder to shoulder in the marble lobby, hands pounding the polished oak. Within hours, the vaults yawned empty and the accountants bolted. Stacks of redemption slips clutched tight, no cash left to give. It wasn't just bad math. It was a stage collapse that would echo through the back alleys of Gotham's hidden finance world. Trust companies, those wildcat cousins of real banks, didn't answer to Washington. No FDIC back then. So when Knickerbocker keeled over, every other trust on the block faced the same tidal wave of withdrawals. Liquidity vanished in a heartbeat, and what began in one building spread like ink in blotting paper across the whole financial district. Source. So why did one tumble wreck the entire city? The answer's buried in the wiring of the age. Trusts were the city's financial plumbing. They moved money for grocers, railroads, even City Hall, all through uninsured accounts that quietly greased the wheels of daily life. When Knickerbocker's doors locked, those accounts locked too, and the city's arteries went still. Merchants couldn't pay their bakers, railroads couldn't settle freight bills, and ordinary New Yorkers stared at rusted shutters where their savings used to gleam. What started as a balance sheet hiccup turned into a panic party. Headlines whispered contagion, and fear did the rest. Depositors miles away, people whose own banks were squeaky clean, stormed branches, convinced the same disaster was coming for them. Market mood swings hit harder than any weak loan book. Source. Behind the curtain, the trusts were all borrowing short and lending long, passing around little IOUs that could be called in on a dime. When Knickerbocker defaulted, its creditors panicked and yanked cash from their own clients. That domino chain turned a little liquidity shortfall into a full-blown system meltdown, something modern economists now label a shadow banking heart attack. Source. The city's fix was a fire drill of private bailouts. With no Federal Reserve to throw water on the flames, the heavy hitters, Morgan, Belmont, and the rest, were dragged into a room and told to cough up. Their patchwork rescues bought breathing room, but they also exposed a gaping hole. America had no official spigot to flood cash into a sinking market. Scholars agree that missing tool turned a bad weekend into a decade-long lesson. Source. As the panic deepened, Gotham streets hollowed out. Newswise couldn't afford ink, so fewer papers hit the stands. Streetcars parked because the drivers' paychecks bounced. Even the ticker tape on Wall Street went dark for hours. The financial nerve center looked less like a powerhouse and more like a set for a silent movie. Every boarded window a reminder that this wasn't just numbers on a page. It was real lives grinding to a halt. So what secret sauce turned one trust's bust into a city-wide blackout? 3 ingredients cooked together. 1. No federal safety net. Trusts held Main Street deposits without a Washington backstop, so panic drained them in a blink. Source. 2. Credit chain bombs. Overnight loans between trusts meant one failure detonated the next node. Source. 3. Fear on fast forward. Once the whispers started, Fear jumped from bank to bank regardless of their actual health source. Together, they flipped a single trust's insolvency into a citywide freeze. The damage wasn't just in dollars. It rewired public faith in the system and seeded the reforms that would follow. By the time the dust settled, Gotham's economy had been stress-tested in ways that would haunt policymakers for generations. The panic screamed that no modern city could run on ad hoc rescues alone. Those lessons, hard won in 1907, would eventually sprout the Federal Reserve a decade later. Next up, how the Knickerbocker collapse forced the old guard into backroom deals. How a handful of Wall Street titans jury-rigged a quick-fix safety net, and why the playbook they scribbled is still guiding crisis drills today. Stick around as we peel back the wallpaper in Gotham's 1907 financial labyrinth, exposing the hidden wires that turned one trust's fall into a full-blown panic, a story that still echoes in every skyscraper's boardroom. In October 1907, New York's financial world was a tinderbox, just one spark, and the whole thing could go up in flames. At the center of that tinderbox stood the trust companies, financial middlemen that were neither banks nor fully regulated institutions, yet handled deposits from small banks, businesses, and wealthy individuals alike. Unlike national banks that answered to federal watchdogs, trusts answered to nobody. No reserve requirements, no clear investment rules, no lender of last resort to bail them out when panic hit. Think of them as the shadow banks of the era, tightly linked, murky as mud, and on the brink of becoming the hot spot for financial contagion. The Knickerbocker Trust Company wasn't the biggest trust in New York, yet it was certainly one of the most eye-catching. By 1907, it had set itself up as a go-to-deposit hub for tiny institutions and merchants looking for a safe spot to park their cash. But unlike the national banks, Knickerbocker kept far too few reserves to meet sudden withdrawals. When rumors in late October hinted that its big bets on speculative copper deals were falling apart, depositors scrambled to pull their money. Within a few hours, Knickerbocker simply couldn't meet the demand. On October 22, 1907, it shut its doors. That collapse wasn't a lone incident, it was a warning sign. Source: Federal Reserve History, The Panic of 1907. The damage didn't end there. Trusts were tangled together by a web of loans, guarantees, and shared exposures. When Knickerbocker froze withdrawals, panic raced through the trust network like a wildfire. Institutions that had lent to Knickerbocker suddenly found themselves in a liquidity crunch. Others, scared of the same fate, started hoarding cash. The FDIC, still decades away, wasn't there to backstop deposits. So when one trust couldn't pay, the next one couldn't cover its own bills. Source: FDIC Virtual Museum, The Panic of 1907. Newspapers of the day chronicled the chaos as it unfolded. The New York Times blared headlines like "Trust Companies in Peril" and "Rush on Banks Spreads Fear." The Wall Street Journal noted that brokers and merchants were pulling money not only from trusts but also from commercial banks, worried that if trusts could fail, nobody was safe. The panic had leapt the fence. Source: SEC Historical Archive, 1907 Panic Analysis. Behind the curtain, the crisis exposed a hidden risk architecture. Trusts had turned into de facto intermediaries, shuttling deposits from cautious savers into speculative ventures. Some poured money into mining syndicates, railroad projects, and even stock market speculators. When those ventures stumbled, the trusts stumbled right along with them. Worse still, many trusts issued cross guarantees, pledging to back each other's debts. So when one trust fell, the liabilities cascaded. Source: Brookings Institution, The Panic of 1907, Lessons for Today. The system wasn't merely fragile, it was blind. There was no central bank to pump in liquidity, no standardized reporting, no transparency about where the real losses were. When J.P. Morgan and a handful of private financiers stepped in to coordinate rescues, they acted as an ad hoc shadow safety net, showing just how much the system leaned on personalities instead of institutions. Source: JSTOR, The 1907 Panic and the Origins of Modern Banking Regulation. The numbers themselves tell the story of contagion. Between October 15 and November 1, 1907, more than 50 trust companies and banks in New York reported runs. Withdrawals surged not because every institution was insolvent, but because fear spread like a virus. Depositors didn't bother checking balance sheets. They grabbed cash first and never asked questions. The result? A liquidity freeze that crippled commerce. Source: Federal Reserve History, The Panic of 1907. Trusts had flourished in the gray zone between regulation and anarchy. They accepted deposits without any federal insurance. They invested in ventures with no oversight. And when panic struck, they turned into the transmission lines of collapse. The 1907 panic didn't invent shadow banking, but it laid bare its dangers in stark clarity. Source: FDIC Virtual Museum, The Panic of 1907. By the time the dust settled, the crisis had reshaped the rules of American finance. But for now, in those last days of October 1907, New York's financial district resembled a war zone, and the trusts were ground zero. The night the Knickerbocker Trust fell, a cascade of panic rippled through New York's financial underworld, and the echo still reverberates today. In 1907, the trust's collapse triggered a wave of withdrawals that spread to other trust companies and banks, exposing the fragility of an unregulated system. Source: Federal Reserve History. Those same trust companies, operating as uninsured intermediaries, amplified the panic by failing to meet demand, plunging the city into a liquidity crisis. Source: FDIC. What happened then is not an isolated drama but a template. The interlinkages between trust companies and banks created systemic risk, a precursor to the shadow bank vulnerabilities that would haunt the 1929 crash and the 2008 financial crisis. Source: SEC. In both later meltdowns, opaque structures and rapid withdrawals turned solvency into a mirage, while confidence evaporated faster than assets could be liquidated. Now, a cache of newly digitized letters from the Knickerbocker board arrives, shedding fresh light on the era's deception. Archivists at the Federal Reserve's digital repository have released internal memos that show executives knowingly concealed liquidity shortages, hoping to stave off a run. Source: Federal Reserve History. The correspondence reads like a script for contagion. "We cannot disclose the shortfall," one note warns, "or we risk a cascade." Such intentional opacity fuels the very fear that market psychology amplifies, a lesson the Brookings analysis still warns about. Source: Brookings. When J.P. Morgan rallied private capital to rescue the system, he was acting as a makeshift lender of last resort, a role that modern central banks now formalize. Source: JSTOR. Yet the architecture of rescue has changed little. In 2008, the Federal Reserve's emergency facilities echoed Morgan's improvised lifelines, injecting liquidity into a web of hedge funds, investment banks, and mortgage conduits, all shadow banks operating beyond traditional oversight. The pattern is unmistakable: hidden interconnections, sudden funding gaps, and a market panic that spreads like a virus. The 1929 crash, too, displayed the same contagion logic. Over-leveraged securities firms, linked through margin loans, saw a sudden withdrawal of credit that precipitated a chain reaction of bankruptcies. The panic of 1907 taught early observers that fear of bank runs could trigger indiscriminate withdrawals, destabilizing even solvent institutions. Source: Brookings. That insight survived the Great Depression, only to be resurrected when mortgage-backed securities collapsed in 2008, sending investors fleeing from institutions they once trusted. What ties these three crises together is not merely chronology, but a shared blind spot: the opacity of liquidity. The Knickerbocker letters reveal that those at the helm deliberately masked the depth of the shortfall, betting that secrecy would preserve confidence. When the secret leaked, the reaction was swift and brutal, exactly the mechanism that ignited both the 1929 and 2008 crises, where hidden exposures were uncovered by auditors and investors alike. The legacy, therefore, is a cautionary blueprint. Modern regulators have erected capital buffers, stress testing regimes, and disclosure mandates, yet the temptation to hide vulnerability persists. Each time a shadow bank network grows without transparent oversight, the system inherits the same contagion risk that the Knickerbocker auditors tried to conceal a century ago. Understanding that lineage forces us to ask, can we ever fully illuminate the dark corners of finance, or will each new crisis simply rewrite the same script? Back in 1907, the Knickerbocker Trust collapse showed regulators just how fast panic spreads when the books stay locked up tight. When those trust companies kept their balance sheets under wraps, depositors came running, and suddenly, every bank was scrambling to find enough cash to cover withdrawals. Fast forward to today, and the shadow banking world, think money market funds, repo desks, and all those fintech lenders, looks eerily similar, still needing strict transparency rules to keep things from spiraling. Modern stress tests, which run through nightmare scenarios like bank runs and market crashes, are basically answering the same what-if questions that kept New York awake in 1907. The Federal Reserve's own archives put it plain: the wave of withdrawals after Knickerbocker folded highlighted the fragility of an unregulated financial system. Source: regulators today have tools the guys in 1907 never dreamed of: central bank lifelines, real-time dashboards, and oversight that crosses company lines. Still, the takeaway hasn't changed. Leave the non-bank crowd unchecked, and systemic risk just pops up wearing a different disguise. The FDIC's Digital Museum spells it out. Trust companies, acting as uninsured middlemen, made the panic worse by not coughing up the cash when depositors asked. Source: dig into the SEC's old files and you'll see the same pattern. Ties between trust companies and banks cranked up systemic risk, foreshadowing today's shadow banking headaches. Source: academics keep pointing out that without a lender of last resort back then, private rescues became the fallback, something we've got to steer clear of this time around. Source: and as the Brookings crew puts it, market mood swings, especially the fear of runs, can set off a chain reaction, dragging even healthy banks down. Source: want to see how those old mistakes echo in today's rulebook debates? Smash that subscribe button, pass the video along, and stick around for our next deep dive series on historic financial meltdowns. Every episode strips back another layer of the past so you can spot the patterns shaping tomorrow's markets. Let's keep the dialogue rolling.